500 million ounces of paper silver, 27 million ounces of real, deliverable metal. That ratio is not a theory. That is the COMEX right now, today, with April first notice day 2 business days away. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Silver is trading at $69.85. The April delivery clock is running. Let's get straight into it. Before we go further, and if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today, the COMEX April silver delivery contract. As of Monday morning, 1,726 contracts remain open in the April delivery month. Each contract represents 5,000 ounces. That is 8.63 million ounces of open April contracts. COMEX registered silver, the only metal legally available for delivery, stands at 27 million ounces. Total COMEX silver open interest across all months represents 500 million ounces of paper claims. Registered inventory covers 5.4% of total outstanding obligations. This follows a January 2026 precedent where 33.45 million ounces were withdrawn for physical delivery in 7 days. That is 26% of registered inventory, gone in 1 week. The unusual detail is not the size of that draw. The unusual detail is the pace. 7 days. Think about what that sequence actually means. If January was 26% in 7 days, what does a repeat event do to a 27 million ounce registered base that has not recovered? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. In the Hunt Brothers squeeze of 1980, silver went from $6 to $48 in under 12 months when physical delivery pressure collided with paper short positions. Registered COMEX inventory then was larger relative to open interest than it is today. The data is already telling you something. Let's build it out. Now let's build the full picture because the April 1st notice day does not exist in a vacuum. The Silver Institute's 2026 Supply and Demand Report confirms 6 consecutive annual supply deficits. The most recent deficit, 2025, was 149 million ounces. That is not a rounding error. That is 149 million ounces where industrial demand, jewelry, and investment combined exceeded total mine supply and recycling output. The Shanghai Futures Exchange is showing a $4 to $8 per ounce premium above COMEX spot, confirmed by Shanghai Futures Exchange daily settlement data. China's Ministry of Commerce issued export restrictions on silver in Q1 2026, citing domestic industrial demand from solar panel manufacturing. Chinese solar installations consumed an estimated 232 million ounces of silver in 2025, alone, according to the Silver Institute. Simultaneously, the COMEX has 3 resolution mechanisms for delivery stress: registered to eligible reclassification, external vault sourcing at a premium, or cash settlement to long holders. Each mechanism has a price. That price is higher than the current paper tape. The rate of eligible to registered conversion is not accelerating. It is stalling. The data is doing the talking. The ones who were dismissed for flagging this paper to physical ratio 2 years ago, they are not being questioned much right now. And here is what makes that picture even harder to ignore. COMEX silver net speculative long positioning stood at 94,847 contracts as of the most recent CFTC Commitments of Traders report, released Friday. That represents the highest speculative long position since August 2020. At the same time, commercial short positioning, the banks and dealers, sits at 112,240 contracts net short. That is the largest commercial short position in 18 months. That is not a contradiction. That is the setup. A record speculative long base pressing for delivery against a record commercial short base with 27 million ounces of registered silver standing between them. And before anyone takes that as a guaranteed outcome, setups can take a long time to resolve. The COMEX has resolved every prior delivery stress without a spot price explosion. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. 232 million ounces per year from solar alone. China's solar manufacturing sector consumes 232 million ounces of silver annually, and that number grew 34% year over year, according to the Silver Institute's industrial demand breakdown. Now Iran, because this is no longer a backdrop, it is the primary variable. Iran denied ceasefire negotiations on Sunday. Houthi forces, operating with Iranian logistical support confirmed by the U.S. Fifth Fleet, conducted 3 separate Red Sea interdiction events last week. The Red Sea handles 12% of global trade volume. Silver's largest industrial demand driver, solar panel manufacturing, depends on a supply chain that routes raw materials and finished components through Red Sea shipping lanes. Insurance costs for Red Sea cargo have increased 280% since January, according to Lloyd's of London market data. Every dollar added to shipping cost is a dollar added to the effective cost of sourcing silver outside normal channels. Markets are still pricing a 15% probability of sustained Red Sea closure according to current freight derivatives positioning. Look at what Iran said Sunday and tell me what probability you put on that. When markets start pricing the actual disruption risk, silver physical sourcing costs reprice higher. COMEX cash settlement premiums reprice higher. That is the historical pattern. Every time a sustained shipping lane disruption has intersected with a physical commodity delivery squeeze, it has not been different yet. Silver Western spot at $69.85. Shanghai Futures Exchange morning fix Friday at $74.20. That is a $4.35 premium, 6.2% above COMEX. Short term, silver is under pressure from a risk-off Monday open, driven by the Houthi escalation. The 20-day EMA descends at $75.90. Silver is trading below every meaningful short-term moving average. If April long holders stand for delivery and registered inventory cannot meet demand without eligible reclassification, silver tests 82.50 within the delivery window based on the structural precedent from January 2026. If April longs roll into July and accept cash settlement, paper sellers maintain control and silver tests 65.40, the Q1 2026 low, before any structural resolution. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower timeframes right now. I cannot tell you what silver does tomorrow. Nobody can. The Monday gap open is unresolved. The Iran variable is binary and unquantifiable. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. First, COMEX has resolved every prior delivery stress through eligible reclassification without a spot price explosion, and eligible silver currently stands at 284 million ounces. Second, April open interest at 1,126 contracts represents only 8.63 million ounces against 27 million registered, a ratio that does not mathematically require a squeeze if roll activity continues. Third, a risk-off macro environment driven by Iran escalation suppresses silver's industrial demand premium and strengthens the dollar, both of which are headwinds to spot price. The bull case is equally real. First, the Silver Institute confirms 6 consecutive annual supply deficits totaling over 700 million ounces, a structural drain that eligible reclassification cannot permanently offset. Second, the Shanghai premium of $4.35 per ounce signals that physical buyers in the world's largest silver-consuming market are already paying above COMEX to secure metal. Third, the CFTC Commitments of Traders report shows commercial shorts at their largest position in 18 months, and a forced short cover at current open interest levels would represent the single largest short covering event in COMEX silver history. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. The structural pressure in the COMEX silver market is not a forecast. It is already built into the numbers I showed you today. 500 million ounces of paper against 27 million ounces of registered metal, 6 consecutive supply deficits, a $4.35 Shanghai premium, April 1st notice day in 48 hours. The only question is whether delivery demand forces the resolution mechanism, or whether the roll activity delays it one more quarter. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CFTC Commitments of Traders at cftc.gov. The Silver Institute Supply and Demand data at silverinstitute.org. COMEX registered and eligible inventory at semagroup.com. Logic over hype, always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. OG John AG 1.0 out.